Jeremy Grantham famously predicted the 1989 bubble in Japan, where it ultimately fell by more than 80% over the following 2 decades, and even today, more than 3 decades later, is still below that 1989 high. Yeah, he saw that coming. He did the same before the dot-com crash of the year 2000 and the US housing bubble in 2007. He also publicly called the March 2009 bottom of the now called global financial crisis, or GFC. You know, when Jim Cramer was panicking and telling everyone to sell? Yeah. Grantham has a pretty solid track record of evaluating global macroeconomic conditions with a level head. And back in January, he published some very compelling research, which I'll link out to for you in the description, that predicted a troubled future for the financial markets and a precarious situation for individual investors. He summarized, all equity bubbles in developed countries have broken back to trend, but before they did, a handful went on to become superbubbles. In the US in 1929 and 2000, and in Japan in 1989. There were also superbubbles in housing in the US in 2006 and Japan in 1989. All 5 of these superbubbles corrected all the way back to trend, with much greater and longer pain than average. Today, in the US, we are in the 4th superbubble of the last 100 years. Previous equity superbubbles had a series of distinct features that individually are rare and collectively are unique to these events. In each case, these shared characteristics have already occurred in this cycle. The checklist for a superbubble running through its phases is now complete, and the wild rumpus can begin at any time. But you should know, that warning came before the war in Ukraine. What Grantham is predicting now, and what you can do about it, coming up. Welcome back, you wonderful 17,000 subscribers. I'm so glad you're here, trying to figure all this stuff out with me. I sincerely hope I can help. Let's get to it. In that previous report, Grantham said we were in the vampire phase of this bull market. He said, you throw everything you have at it. You stab it with COVID, shoot it with the end of QE and the promise of higher rates, and you poison it with unexpected inflation. Until just as you're beginning to think the thing is completely immortal, it finally keels over and dies. That's how he described what was happening at the beginning of this year. The market's bubble was reluctantly starting to deflate before it would ultimately just capitulate and come crashing down. It was in those final throes of impending death. But then came a massive variable out of left field, Russia's war with Ukraine. And in a recent interview with ThinkAdvisor, Grantham warned that when a war starts, everything is scrambled, and it multiplies all the uncertainties. The outcomes stretch all the way from, at the good end, regime change in Russia and everyone lives happily ever after, to nuclear war at the other end, and everything in between. This is serious stuff that's going on. The risk profile for everybody has gone up because you can't rule out the Russians being a bit crazy and irrational. Putin is a borderline psychotic, and war is a complicated event, full of unintended consequences. When asked about the theory he posited earlier this year, he said that it seemed so obvious at the time, so oddly similar to what happened just before the crash in 2000. But there's never been a war thrown in the middle of a major bubble like this. I was pretty darn certain that we were in the late stages of a bubble breaking. Now I have to put an asterisk against that and say, if I had to guess, it will end up at the same place though. But I've learned the hard way that when you throw new things at the economy and stock market, unpredictable things happen. So there's an irreducible increase in uncertainty. I talk about this in my book as well. This is one of the problems with the stock and bond only buy and hold investment philosophy. It assumes that the past adequately accounts for every possible combination of variables in the future, which of course is ludicrous. It doesn't. It can't. We've never been here before. We've never experienced this unique combination of inputs that will ultimately determine where our financial markets will be in the long run. Grantham warns, as I have as well in my book, you have to be prepared for anything. The market is in a bad place, and the war bodes very badly for global growth and global trade. It bodes badly for price rises. That's all fundamentally pretty grievous. We've learned the hard way that fundamentals are one thing, and the stock market and paper are another. Specifically, he talks about not knowing what governments around the world will do. That's a big variable that we've talked about here on this channel. There will likely end up being a lot of political pressure to stimulate the economy further, a QE5, if you will, another wave of stimmies. And although it seems obvious, to me at least, that behavior in the past, really since 2008, but it's just gotten worse and worse since then as new, never before even imagined precedents keep being set, that behavior of stimulus, of quantitative easing, has been the number one contributor to our massive inflation problem today. But you can see the spin of the official political narrative trying to grasp onto whatever other scapegoat it possibly can, like the convenient scapegoat that is Vladimir Putin, for example, that could conceivably pave the way for yet another round of stimulus, which would absolutely cause a short-term surge in the stock market, along with even worse inflation and an even worse crash whenever it finally does come to bear. Here's Grantham's take on the long-term prospects of the US stock market should things play out in this ill-advised way. But how do you know they're not going to do it? In the end, you can't get blood from a stone. If you have overpriced stocks, you get a dismal return. And we have overpriced stocks, and we will get a dismal return. Although he clearly sees the same significant drawdown on the horizon as he did when he first wrote the superbubble theory at the beginning of the year, he says the flight path is not as certain as it was a month ago. Now, one of the signs he outlines in that paper of a superbubble is investors making crazy investment decisions. It's an easy phenomenon to identify at the peak of any bubble in hindsight. Of course, it's more difficult to recognize in the moment. When asked if the war has increased investors' crazy behavior, Grantham explains, the US market is the main event in the bubble business. The US market today sells at a higher price than in 2019. COVID and the war have increased the long-term value of the US stock market, apparently. It wouldn't seem rational that would be the case, but the real-world GDP is bleak and totally divorced from the paper world of stock prices. And the war has just brought more of the same. Individuals today are investing at a more rapid rate into the market decline than they were into the market rise, which is unheard of. There's a lot of abnormal support for the vampire, a blood transfusion, if you will. All of it coming indirectly from the stimulus. If you're an investor trying to figure this all out, trying to figure out the most savvy thing to do with your money when presented with such a precarious and unprecedented state of affairs, if you look at the mainstream financial advice, including many of the most popular financial YouTubers, most of them just fall back on that tired old regurgitation of buy and hold or stay the course. But maybe you're here because when you hear that mantra, you still feel like something is missing. Like real critical thought, perhaps. You feel as though there must be some better way. And you should be concerned. You're right to be here trying to get this all figured out. And this isn't fear-mongering, this is reality. When asked about what advice financial advisors should be giving their clients, Grantham says, the honest advice would be, uncertainty levels have risen, and therefore you want to be a little more conservative, don't you? Every time uncertainty goes up, you want to have a little more in cash in the bank, and a little more reserve. That's a truthful no-brainer. Secondly, you want to point out that you don't know what the government will do, and that, yes, there's some possibility of enough stimulus to cause a substantial move upwards in the market, but that the underlying fundamentals have deteriorated on quite a few levels. Interest rates, inflation, stagflation, supply lines, shortages. It's just a thoroughly unpleasant set of incremental risks. I don't think that means you should be all in cash or something like that. In fact, given the state of inflation, that would actually be one of the worst stores of value for your long-term assets. There are opportunities out there, and I want to help you find and more importantly, know how to find them. But first, I want to make sure you're aware of the dangers. You have to be careful. When pressed for specific investment recommendations, Grantham offers, what I say is, the US is crazy and abnormally overpriced. So step one, avoid the US. If you want to buy equities, go overseas. Step 2, find the cheaper ones. There are some countries that are pretty close to fair value, Japan, the UK, and a few others. Step 3, build up a little extra liquidity, cash or cash substitute. I personally have a little gold and silver, and I would recommend that investors seriously consider resources. Resources do very well with inflation, and we are seriously short of practically every resource looking out over a decade or longer. I mentioned that in this video I created earlier this year about profiting from inflation. And yeah, the commodity investments I've had since that time have done extremely well. He also reiterates another point that I've made repeatedly regarding the decision to invest in bonds. Again, many financial gurus and otherwise perceived experts will just blindly recommend bonds as an unquestionable part of every investment allocation. He says, I'm entirely sympathetic to someone who's running a pension fund, because it's not just that US stocks are horribly overpriced. US bonds pretty well have a risk guarantee of an ugly future. You start with bonds that face a future of inflation and higher rates, and a very unpleasant economic future, not just for the US, but globally. What are you supposed to do as a pension fund officer? You're supposed to wake up in the middle of the night screaming, I think. There's no easy answer. Ouch. Luckily, as an individual investor, you have much more flexibility than the pension fund manager. Grantham concludes his investment advice by just reminding you to be very, very careful. I couldn't agree more. It starts with understanding how bad our financial situation really is. I made this video right here to help you understand how bad our inflation problem is, for example. And this one to help provide you with some of the context Grantham is using to draw such grim conclusions about the state of the US economy. I can't wait to see you in the comments here and there. I love getting to know you all better. I wish you all the best. Take care.